हाय वरुण, बोलो ना। वन मिनट हाँ।
Mr. Varun, can you hear me?
Yep, I can hear you. Just give me 1 second. Just give me 2 minutes. Just I'm trying to
Yeah,
just
sure.
fix my camera and stuff. Just give me 2 minutes.
Sure. We will start once a few more people have joined. So till then we have time.
Sure, go for it. I am ready. So whenever you guys want to start, please do let me know.
Sure, sir. So we can start now if you are ready.
Yeah, I'm ready. I'm ready.
All right. So, hello everyone to Investza's monthly market update, your trusted destination for real financial insights. I'm Aisha, and today we have with us Mr. Varun Sanan. He is the Vice President, Head Equity Passive Fund Sales at Edelweiss Asset Management Company. He has over 17 years of industry experience, and today he's here with us to discuss key highlights on Indian markets for the month of August, sector leadership, FPI activities, policy changes, and global news shaping investor sentiments. Mr. Sanan, thank you so much for joining us. So let's start with the very basic question, the top line view of Indian markets for the month of August. How did they perform?
Thank you, Aisha, for having me, and happy to be speaking with everyone. Uh, Good evening, and I hope the markets are keeping you on your toes as they are keeping us on our toes. We've had a very strange year. So let's before the month, let's just speak about how the calendar year's been so far. So we've had a quite a strange year. We started off where markets were actually doing nothing, and the markets were absolutely negative. We went down by about almost 8 to 10%. And then the recovery seemed to happen. And year to date, on the Nifty 50, which is a prime index, we're up about 6%. Within that, the months to date number is about 1.5%, 2%. So what you're witnessing is that the markets are tracing their way back now. And a lot of this is given the fact that uh, a lot of earnings downgrades for companies has now ceased. So, analysts are believing that we're probably at the bottom of the earnings downgrade cycle. What we're also witnessing is that the tariff war, which is so heightened, and we will probably speak about it a little more in detail later on, but the tariff war seems to now getting into a resolution mode. So that resolution mode gives markets some bit of comfort that things will not go worse from here. And finally, what we're also witnessing is the biggest central bank of the world, which is the US Fed, is now talking about interest rate cuts. From the last 1 year, we've been talking about US will cut interest rate, and in fact, the calls happening at a very opportune time. We had a 25 basis cut in the policy recently. So all that has now started, and I think markets will trace their way back, and we're looking at a reasonably optimistic time from here.
Okay. So, sir, in this recovery phase, which sectors do you think will perform well or which sectors will lag?
So let's just put up some data on the screen for people, for them to make sense of all of that. Just give me a second. I'll probably share my screen. Yeah, I hope you can see my screen. So what we've plotted are different sectors of the market, and what you can clearly see is that, and focus on this year to date number. That will give you some perspective of the last 8 odd months. And what you see is sectors like IT, sector like reality, etc., have taken a big knock. They have actually corrected significantly. And IT obviously is impacted by US earnings and US policy mechanism, and that is why IT has uh, done so badly. But all of that is changing now. And what we're witnessing is that IT is a sector that will lead the recovery now. It's already started doing well, and this stems from the fact that the investments in IT in the US have started happening again. Some of you, if you follow the news, you would have seen the earnings upgrades that came from the US tech companies, especially companies like Nvidia, Oracle, Synopsys. A lot of these guys have upped their earnings and projections. So it's great to be in IT. It's also a good time to be in consumption oriented sectors. So something like automobiles, something like consumer discretionary, you know, staples, etc. These are big beneficiaries of this, GST change that has happened, which is going to push demand because of prices coming down. So that demand that was held out will start coming back up. So some of these sectors look very, very promising. And finally, we think that the backbone of the economy is the banking sector. Banks have been a star performer in the last 6 months, and we think they will continue to do so over the next 6 to 12 months. So that's where we think these 3 4 places where the real returns will be made.
Okay. That was very well explained. But now I think we should deviate towards the domestic policy changes that have been occurring, and that is the GST policy that was recently reframed. And many companies, for example, Mother Dairy, they have already changed their pricing in tune with the new GST policy. How is that going to affect us?
So the GST rationalization, where the slab rationalization in rates in different categories that came about. So it will help us in two different ways. The first is, as prices come down because of rationalization, more clients will go, or more customers will go and consume. So that will increase consumption, which is great for specially listed FMCG companies, auto companies, retail companies, and this will also boost their margin to a great extent. So what will actually happen is that this entire GST policy will push demand forward, increase margins for these listed companies. The second thing that will happen is uh, that from the standpoint of compliance, as GST becomes more rationalized, more compliance will start following, which will increase the tax net of the government and more tax inflows into the government's kitty. And with that money, the government, which already is on a big capital expansion cycle or infra development cycle, that will actually help the government with that money that comes in. So that itself will start adding to the economy at some stage. May not be straight away today, but maybe 6 months later or 9 months later, which is great for the economy from a long-term standpoint.
Yes, definitely. But now the question arises that India is showing robust growth, but there is a constant outflow from FIIs, whereas the DIIs are constantly keeping the money in the country. Why is that?
So let's first focus on DIIs and then we'll go to FIIs, because both have very different behavior. Now, as Indians, we are big savers. Inherently, we are poor people, and poor people save. They always end up saving. So our if you take a look at our per capita income is just about 2,500 US dollars, right? Compare this to other economies, which are emerging economies like China or South Korea. South Korea's per capita income is close to $20,000. China's per capita is about $13,000. So, we are far less than them. So we're quite poor in that term. And because we're not that well off, we are always worried about our future, etc. And inherently, we are savers, And because of that saving attitude that we have, we want to invest money. Now, investors have for the last 4 or 5 years witnessed great returns to come from stock markets, and the awareness level has also gone up. And that is why what investors have started doing is they've realized that, hey, this is a great place to invest. It is volatile. It will not give you straight line returns like a bank FD, but what it will do is it will give you, great returns over a period of time. And for that reason, a lot of domestic investors have started using mutual funds as their investment avenue and started investing in mutual funds through lump sums and SIP. And that is all that money is keeping the markets afloat and keeping the domestic investors or DIIs to keep pumping money in. Because every month, I am a DII, Edelweiss Mutual Fund is a DII. Every month, we're getting 3,000-4,000 crores. Now, that 3,000-4,000 crores, we can't sit on cash. We have to deploy. And because of that reason, we are deploying that money every month. Now, coming to the second part, which is foreign investors or FIIs. So, FIIs are, viewing it very differently. So what FIIs are viewing it is, and let me put another chart there, which will give you some perspective in terms of what FIIs are doing. So what FIIs are looking at India is that India is a market which just give me a sec. Let me just put this chart for you. Yeah. So if you take a look at something called as the valuation of the market. So what FIIs do is FIIs look at the expensiveness or cheapness of the market. So they basically go into markets that are cheap. And if you take a look at India, India is the second most expensive market in the world after the US. So they are anyway saying that India is a little expensive and India has got great returns. At the same time, you have markets like Turkey, which are very, very cheap. You have a Vietnam, which is very cheap. You have China, which is super cheap. Brazil. So all of these, or even a South Korea or a Mexico. So all of these other emerging markets look cheap. So FIIs are saying that, hey, let me put some money there instead of India. I made enough gains in India. The second big thing is that is actually playing out, and this is the first part that I mentioned was a smaller part. The bigger part is because of this entire tariff war and people not be FIIs not being very certain on where Donald Trump's next policy or next tweet is going to be. They are saying let this dust settle down. Once this settles down, then probably we will know that where should we come? Should we come to India or should we go overseas? And for that reason, what you see is take a look at this number, which is FII inflow outflow. And this is calendar year to date. What you see is calendar year to date, India is the largest outflow market. We've lost close to 16,000 crores 16 billion US dollars so far, compared to a Brazil, which is positive, compared to a Taiwan, which is positive, and the other economies haven't lost that much. So clearly, FIIs are waiting for some bit of semblance from the tariff wars to settle down, geopolitics to ease, and that's when they will come back to India. But look at the DII number. It's a fairly strong number, and they're continuing to invest into India. Almost $60 billion of investments have come into India.
Yeah, definitely. But in a market which has so much volatility going on, there are also certain risks involved. Could you just highlight some of the risks that retail investors could face in the upcoming market?
Sure. So I think three risks that people should keep in mind. The first risk that I think is the most dominant risk which people should keep in their mind is that they are not investing in India cheap. So India is fairly expensive. So if there was a downturn or a sharp downturn, you will get a correction in the market. And I will just show you the chart. So look at this chart on your screen. This is in terms of valuation. And this dark blue line in the middle is where the valuation should be. But today it is somewhere in this range, which is expensive. So it clearly means that markets are expensive. So they will not give you returns in immediate future. You'll have to hold on for a period of time. So if you're thinking that you'll come into the market and in 6 months you'll make returns, that probably will not happen. But if you hold for 2-3 years, India's got great demographic dividends, huge growth, with the fastest growing economy in the world, you will make money. So the first risk is that. The second risk that we're clearly seeing is Indian investors have become overtly aggressive. You know, uh, when we look at portfolios, we don't see that fair allocation or asset allocation in place. A lot of people said, hey, I will not do large cap, I will not do this. And most of the investments started going into mid and small caps. And if you see the valuation in small caps, which is up on your screen, this middle line is average where the valuation should be. This line is expensive. We are actually more than expensive. We are at the far end of our valuation. We are at close to the historic high of our valuation. And given that, asset allocation is prudent, you should move money from small caps to large caps, or go to some defensive funds like the multi-asset or hybrid strategies. Gold as an asset class, silver as an asset class should be taken into the portfolio. Fixed income, which is giving you stable returns, should be looked at. So the second risk is this overtly imbalanced asset allocation towards small caps. And the third big risk that we are clearly witnessing is that people are, or markets are actually discounting the earnings slowdown. Markets are saying that, hey, earnings will just pick up. It doesn't work like that in the real world. And I will show you some data around that also. So earnings, when they fall for a fair period of time. So look at this earnings growth. So this is just the growth of earnings, So when earnings do well, they do well for a long period of time. When earnings do badly, they do badly for a reasonable period of time. So you had this entire period where there was no real earnings growth. This period of 2010 to 2016 was when there was no earning growth. So 2010, there was another government, and then 2014 was when this present government came into power. And they came into power and demonetization happened and a lot of GST reforms, and all of that takes time. And then from 2018, this earnings upgrade cycle started. And we had a 6-7 years of earnings upgrade. Now we are going into consolidation mode. And in this consolidation mode, you will not, see returns coming in a big hurry. And that is why we think investors should taper down their expectations of returns from the market. What has actually happened is, if you look at this chart that I'm going to show you now, and I'm sorry for going all over the place, but please be with me, focus on the chart that I'm going to show you. So what you see on this chart is that, look at the numbers, 10-year returns of Nifty 50. The 10-year returns of Nifty 50 are in the range of about 13%. Look at the 5-year returns, they are in the range of 18%, which basically means that the long-term average was 13%, but you got in 5 years, you got 18%. So the next 5 years, you might not get 18%, you might not even get 13%, you get close to 10%, which is going to get your average back to 13%. So taper down your expectations. So we think those are the three big risks that we see on the horizon.
Yeah, definitely. But again, sir, you said that Indians are becoming overly aggressive in terms of their valuations, and at the same time, we have the gold and the silver, which has continued to rally for the past 1.5 years. In fact, Indians have added 6% of world gold into their portfolios in the last 1.5 years itself. Where will this rally finally stop? Because that
I don't
is
know.
also an aggressive rally.
I don't know. Only if I had a crystal ball, I could give you an answer for that. But honestly, I don't know. But what I know for sure is this rally will continue till the time central banks are buying gold. Because what's actually happening is this big de-dollarization trade is going on right now. So uh, a lot of countries, especially China, Russia, they are not going and buying US treasuries. Otherwise, what they were doing 10 years back was going and buying US treasuries. They're not buying them now. What they're buying instead are gold bonds of physical gold and storing it in their vaults, including India. India has bought 800 tons of gold. China has bought almost close to 2,000 tons of gold. And maybe I have that number somewhere. Uh, should be coming up on your screen. I might be able to pull it out. So take a look at this. This is what uh, the blue line is the US Treasury holdings. And if you see, they've gone down. And the yellow line is gold holdings. And if you see, they've sharply gone up. So clearly, what's started happening is that a lot of these central banks are buying gold. And till the time they keep buying gold, because their quantities of gold buying are huge, and the amount of gold being mined in the world is reducing every year because gold mines are also finishing their gold reserves, right? So till the time this buying of gold keeps happening, gold prices will continue to do well. When they will stop buying, uh, the answer is anyone's guess.
Maybe gold and silver will not stop anytime soon, but that also backs the question of the Indian gold bonds that the government has issued. Indians still prefer to buy physical gold. However, we have seen some kind of change in the recent years, but the bond market hasn't responded equally in that sense. And what are the latest global developments for sovereign bonds that you see?
So, all of this takes time because who buys sovereign bonds? It's not central banks who buy sovereign bonds. Central banks predominantly buy, uh, you know, gold, physical gold as reserve. Also, Indians don't buy sovereign bonds because Indians buy gold for jewelry or physical gold. We have this big fascination for physical gold. And that fascination is not going away. Women, we thought, are maturing in terms of their taste, but in terms of their gold requirement, it's not going down. So clearly what's happening is we have this affinity to physical gold. But the people who are actually buying sovereign bonds are people who are investors, purebred investors. And those investors uh, are also mindful of the fact that gold has moved from $1,800 to $3,600. That's 100% up move. And there, people are waiting for some bit of correction to come their way before they further start adding. So, what you will see is if there is a correction, if gold goes back to say $3,200 or $3,300, you'll start seeing another upsurge in demand for sovereign gold bonds.
And considering that in the past 1 week, gold has been consolidating, that could be a clear indication of what you're saying may happen in the near future itself. Okay. So, since we are nearing the end of the session, can I would just like to quickly sum it up since, and also I think we just have like one more question. Okay. If a retail invest, you said that mutual funds are the way to go for proper asset allocation. If we could get a more in-depth, detailed answer on that. Then that'd be great to end.
So, clearly what we think is that uh, retail investors need to now look at the markets a little differently. Retail investors need to see that only equities and small cap equities are not the way forward. There has to be a proper asset allocation. You have to sit down with the advisor, you have to measure risk, you have to understand what the risks on the table are. Some risks on the table are the fact that markets are overvalued, which means you have to taper down your mid and small cap or even equity exposure. The second big thing that investors have to take a look is that fixed income, which is a great asset class for stability of returns, should be added in the portfolio, and more so now because as interest rates start getting chopped off, fixed income yields or fixed income returns are inversely related to interest rates. So as rates go down, returns for fixed income funds will go up. So have an allocation to fixed income, not just from return standpoint, but also if there is a correction in the market, you should have money to be deployed then, right? So do that. Finally, precious metals or gold, silver should be part of the portfolio. And we also think that just don't think India, think outside India. There are economies outside of India which are doing very, very well. US is a great economy. There's some uh, mind-blowing tech companies which are doing some really exceptional work. They are growing very rapidly. The future of it, the world is actually dependent on technology. All of that tech comes from the US. So if it's Nvidia, which is making the most, cutting edge uh, chips, which are working on artificial intelligence, or if it's Oracle, which is doing really big work in cloud computing, which you and me are using for a lot of our work. These companies have a very big runway and 10, 20 years of runway of growth. Invest in those companies through a US based fund. China has done nothing for the last 3 years, and I just showed you the valuation, how cheap China was. Maybe I can put that chart again, in case people have forgotten that chart, and show you that chart. Look at how China is. So China is at about a 14 multiple. At the same time, India is at a 20 multiple. China is much cheaper compared to India. And in terms of growth, there is a lot of growth that is happening in China. It's the second largest economy in the world. At one point in time, it will become the largest economy in the world. So you will need to have, or you should have in your asset allocation, exposure to China as well. So I think, that I think is the key driving message, that have exposures to different economies, different asset classes, because finally, let me end it with this one chart uh, to really, really sum up things. This chart tells you a story. This chart tells you that, every year there is a different winner. So there are years that Indian equities are the number one asset class. So in 2021 or 2023, Indian equities was the number one asset class. But in 2017, Chinese equities were number one. Or in 2019 and 2024, US equities were number one. Likewise, year to date, gold and silver are number one. So, this will keep changing. If you have the right asset allocation, you will benefit out of this, because there will be years that Indian equities will give you negative returns, and hugely negative returns. There will be years that US equities give you huge negative returns or no returns. So in a year like 2018, you had nothing that came from Indian equities. 2015, you didn't have anything that came from Indian equity. A 4% return in 2022. So, you will get these years, and maybe the next year, and like this year is just 1%. So maybe the next year is the year for China or even India. So have that right asset allocation, and you can't go wrong.
All right, so with that, we wrap up this special event. Thank you so much, Mr. Sanil, for sharing your expert perspective. And thank you to all our viewers for joining us for the Investza's monthly market updates. And you can stay with us for many more expert analysis throughout the month. Once again, sir, thank you so much. And with that, we can come to an end.